This is the secret to becoming rich as a crypto trader. And no, it does not involve excessive leverage. It does not involve buying random meme coins, and it definitely doesn't involve joining my paid group. So if you're a regular viewer, last week, you know I shared a video talking about $3 million of losses I've taken over the last 8 years. But despite all those losses, I've continued to see new net worth highs every single year. And the principles I'm going to share in this video is how I've managed to do that. I know people that have made way more money than me. They've hit 9 figures, but they've actually ended up being poorer than me right now because they did not have these principles and they did not understand this. Trading has something called the 3 pillars. And if you're missing any single one of these pillars, there's no way you can possibly make money. So pillar number 1, which you guys are familiar with, is strategy. Now, people obsess not even over this category, but over one subsection of this category, which is analysis. All YouTube videos you see made around this: which indicator should I use? Should I use Elliott Wave? Should I use technical analysis, smart money concepts, market structure, whatever it is? Like, people obsess over this one subcategory of trading. It's important, but tiny. So you got analysis, you've got journaling, and yes, I hear you guys. A lot of people have been requesting a journaling guide. This is coming. You'll find out about it first in the Telegram. I'm not charging you for it. It'll be free, but when I do release it, it'll be in the Telegram, and I'll probably release it on YouTube and Twitter at some point as well, but Telegram will get it first. So if you've got good analysis, good journaling, then you're going to be able to get a good strategy. There's another category, which is strategy development, but we don't need to focus on that right now. Next, we have good old psychology. This isn't going to be a psychology video, so we don't need to talk about that, but we will zoom in to what we're going to focus on in this video. Survival. The reason I've managed to continue making money, the reason I've managed to never really be wiped out of this game, is because I am outlasting all of my competition. When it comes to trading, when it comes to investing, when it comes to business, survival is my number 1 priority. So what does survival mean in trading? And I'm going to give you a full framework for making sure you survive as a trader. And no, survival is not just placing a stop loss. You're going to get much more than that. We're going to start with risk. And this will be risk as a macro concept that we want to fully understand. You need to not just look at your trading, but look at your entire life and make sure there are no single points of failure, no black swan events that can happen that will wipe you out. If you have $100 and you win the craziest trade possibly imaginable, and you end up with $100 million, and then you bet this $100 million, that can go to zero. It's just 99.99 whatever % loss, and you're back where you started. You think this can't happen? Well, I've seen worse than this happen. I've seen people go from 250 mil to 50K in debt. And this isn't just from trading. This can happen from several different points. We've got platform risk, so it's everything on one platform. Doesn't matter if it's a bank that's been around for over 100 years, doesn't matter if it's a new crypto exchange. No more than 20% net worth on any one platform. No more than 20% net worth. This means, worst case, one of these platforms go down, you take a big 20% hit, but it's a survivable hit. Now, if it's a high risk platform, you can take this number down, and you can use a leverage trick in trading to reduce your total exposure to any one platform. Say your trading portfolio is $100,000 and your net worth is $400,000. So you trade with about 25% of your net worth. Now, if you put this on, say, I'll just use Phemex as an example. Phemex is decent exchange, but it's not tier 1, and it's often, for a lot of people, the only thing they can get KYC access to. You do not want to put $100,000 on Phemex, and I use Phemex, I work with Phemex, so I'm incentivized to tell you they're great, they're safe. They're not. No one is safe. Not Coinbase, not Kraken, not Phemex. It does not matter. You're always mitigating your risk as much as you can. So how do we use leverage to help us do this? Well, instead of putting 100K on Phemex, you put 10K on Phemex, and you use 10x leverage. So now we're changing the game up. Instead of using leverage to increase our risk, we're using leverage to mitigate our exchange exposure. This is why I think every crypto trader should be using leverage, not excessively as a means to make more money, but actually as a preventative measure. The next type of more macro risk that we want to be aware of is strategy risk. So how much are you willing to actually lose on a strategy before you determine it's not working and it's not worth it? Is it 10%, 15%, 20%, 25%? Have a hard stop for any one trading strategy. And it can also be incremental. After you use 15% of your total portfolio on one strategy, you can reduce position size drastically until you figure out what's going on, why it's not working, retune it. So have a cap. So we're going to put a loss cap on our strategy. Finally, one of the most overlooked risks is you. Now, I know when I become a risk. If I go on big win streaks and my ego starts to inflate, I'm likely to deviate from my strategy. But it's not just that. Like, if you're in a toxic relationship and you get into a big argument with your partner, do you really think you're going to go to the trading screen and make rational decisions? Personal issues can absolutely devastate your trading. So a good preventative measure for this is a pre-trade checklist. So here's an example. Before any trade, or rather any trading day, I have to start by going through this list. So firstly, have I had a walk this morning? Yes, got some exercise in. Have I slept at least 6 hours? So less than 6 hours, I don't know anyone who can trade well. Never met a single person. If you think you can, sweet, go for it. But make sure you've actually recorded that in your journal. Just take a look at how you perform on days where you've slept less than 6 hours versus more than 6 hours. I promise you, you will see a difference. It's the equivalent of being drunk. It's like if someone tells me I can trade well on less than 6 hours sleep, they're telling me I can trade well drunk, which is like, cool, fine. If you think you're that good, go for it. But even someone who can trade well drunk would probably be disproportionately better not drunk. Hunger. Now, some people like to fast and do well with fasting, intermittent fasting, which actually works if you've got a really good, stable diet and you're not super athletic. If you're doing large amounts of cardio, it can be a little bit difficult combined with intermittent fasting. So just be careful with that. But most people, again, make sure you've got a little bit of food in your stomach. You will tend to perform better. Lastly, ego. So I use meditation for this. I check in with myself. Am I feeling particularly anxious, particularly great today? Because euphoria can also be difficult for trading. Just check in on myself. For me, that's 10 minutes of meditation to see if I can get a calm mind, focus on an object. And then if I can't focus on that object, normally there's distractions. The content of those distractions can tell me likely what's going to trigger me that day. If I'm sat down trying to meditate and I can't stop thinking about an argument I had last night with my significant other, then that tells me, okay, that's on my mind. I'm thinking about that. I need to stay aware of that. And if it ever comes up too strong during trading, maybe I take a step back, maybe I call it quits for that day, deal with that and return to the charts. I always stick to these rules. The checklist has evolved over time and I've gotten more strict with it. I used to not be as strict with this and it's cost me a lot of money. But the macro risk and strategy risk is something I've been a lot stricter on. It's why in my first bull market, when I went up to about 1.2 mil at the peak, I lost a lot of money and I came down to 800K, but the safety measures I had in place stopped me getting wiped out. It's a big hit, way bigger than I've ever should have taken and probably the biggest percentage hit I've ever taken, but it didn't wipe me out, but it left me with enough money to build from. So now let's go into trading survival. This is the key here because all you need is the right destination and consistency, and you will make it in this game. You don't need to be that smart. And this is the thing, all you need in trading to make it is the right instruction and consistency. If you have these two things and you don't deviate from your path and you don't get liquidated and wiped out, you will make it. So the most important thing to get rich in trading is knowing exactly how to survive. And that is not placing a stop loss. That is not even close to enough. First, we need to define how much we're allowed to lose per trade and why. So we're going to start with the 5% plus range. So if you're risking more than 5% per trade, this is, to most people, a normal amount to risk. To me, this is degen. Now, it becomes clear why this is a bit more on the degenerate side when you take into account win and lose rates. So if you have a 60% win rate, which is on the higher end, I know people who make money with 30% win rates on strategies, you still have a decent chance of losing 6 trades in a row. I think it's like 1 in 240, 50, something like that. So you have 1 in 250 chance of you losing 6 trades in a row. That's not that low. Over a multi-year trading career, it's almost guaranteed to happen. And the chance reduces drastically if you go up to 10 and it gets closer to like 1 in thousands. But remember what we spoke about. We don't want to get wiped out. We want to remove black swan risk. And at 5%, we've got a real possibility, a very real possibility of losing half our portfolio, which means we then need 100% to make it back. If we go from 100K to 50K, that's minus 50%, but we need plus 100% to get back to where we were before. Now, there is a very big exception to this, and that is with low sample size events that have a lot of backing. So if you develop a really good strategy, we'll call this Strat X, and whenever, for example, you get a really nice pattern with volume on this strategy. So it's a momentum strategy and volume is gradually going up like this. This is perfect for you. You know you crush when volume does this. You increase your bet size when this happens. So what can also happen is if there is a positive news event, you actually know this strategy crushes as well. If there's also an announcement from the project, so you've got an announcement from the project, you've got really good macro news events, so it's a great environment, volume's doing exactly what you want it to be doing. BTC is also lined up exactly how you want it to be. This is multiple confluent factors that increase your probability of winning a trade. They're all happening at the same time. This happens rarely, once a year at most. Then, this situation, you may want to go to 5% or higher. This is the only situation. Low sample size, high probability events are the only situation where it's worth exceeding this risk level. So next we've got the 3 to 5% range. And the 3 to 5% range you can do with a few of these factors. So if you've got multiple things lining up, it's looking really good, not quite, once in a rarity event. This is a really high risk place to go. And you still don't want to do it too often. 3% is high. 2% is medium, and 1% is low. So 1% risk, we've got really low. Sometimes I even go down to 0.5% if I'm testing a new strategy or less confident in this strategy, or maybe I'm emotionally not in the mood to trade with full size. Now, these are rough guidelines, so you could argue that like 0.5% is low, 1 is medium, 2 is high, 3 is degen territory. You can move this up and down a tiny bit, but the general guideline remains. This is a lower area, this is a medium area, this is high. This is very high. I do want to emphasize how most traders, probably 90% of you watching this video, should never touch 3 to 5% range, and then 5% plus is degenerate. It's very degenerate, it's arguably gambling, but personally I do go 5% plus if I have multiple confluent factors lined up and I've got high conviction in the trade, but I also have a lot of confidence in the skills I've built over the last 8 years, 24/7, obsessed with this space. In order to apply these specific risk parameters, so we have account size, risk per trade, and stop loss distance. This is how we calculate position size. So if your account size is, say, $10,000, and then you're risking 1% per trade, and you've got a stop loss that is 10% away. That means on this one trade, you will be okay to risk up to a $1,000 position size. This is where also the second smart way to use leverage comes into play. Let's say, for example, you have an account size of $10,000 and then your risk per trade is 1%. So this time though, the distance of your stop loss is 0.5%. You're trading on the 1 minute time frame, you've got an extremely tight stop loss. In this instance, it actually becomes okay to use leverage and enter a $20,000 position. And you're not being risky. This is not excessive leverage. This is completely within your risk bounds. Because if you have a $20,000 position and your stop loss gets hit for 0.5%, you will only lose $100, which is completely within your risk parameters. I know this risk stuff can be boring, but it's the single most important reason I've managed to get to where I am today, and I hope this video helps you get to where you want to go.